We're on to segment number 12. This is salary deferral contributions and pass-throughs. This is where you account for taking your own money and putting it into your self-directed retirement account. Okay, is that right?
That's right.
And I think it mostly concerns sole proprietors and LLCs.
Yeah, there's two main ways how you can put money inside the retirement plan, brand new contributions. You're going to have the salary deferrals and you're going to have the profit sharing. So whenever we say a 401k contribution, that means salary deferral.
I mean, that's coming out of your income, and then the profit sharing, the company's taking and adding to or matching you or whatever.
Exactly, that's what's happening. And then there's, to get it even more confusing, there's one set of rules whenever we're dealing with a sole proprietorship or a partnership, and there's another set of rules dealing with corporations. So let's talk about the salary deferrals right now for the pass-throughs, which is the sole proprietorship and the partnership. You ready?
Yeah.
Okay, cool.
But you're losing me at the word pass-throughs because I don't know what that is.
Oh, pass-through is what fancy legal people like to say to sound educated. It's just basically a sole proprietorship or a partnership. That's all. It's not a corporation,
okay.
So long as it's not a corporation.
Okay, so the money just passes through right to the individual.
Correct.
That's what it is? Okay.
That's what it means.
It's like an S.
Well, no. S is a corporation. Let's not even go down there.
Okay.
Yeah.
All right.
You're starting to confuse me, Mitch. You're starting to confuse me.
Oh, yeah. I was confused a long time ago. All right, so sole proprietorships and LLCs taxed as a partnership.
Okay. So how much can you put in for the 401k contribution? For the 401k contribution, you're allowed to put in the lesser of 100% of how much you made in that business or $19,000 for 2019. So once again, you're allowed to put in the lesser of 100% of what you made in that business or $19,000. And stop and think about how cool this is. A lot of people say, oh, I'm going to set up a SEP. Oh, I'm going to set up a simple or something like that. Okay, well, you really can't put much money inside those things because let's say that I had a side business. It only made $15,000. Under these rules, how much of that $15,000 am I allowed to put inside my 401k?
All of it, right?
All of it.
Because it's under $19,000.
Yeah, how cool is that? With a SEP, I could put in a whopping $3,000 or something like that. So this is kind of the power of these 401ks is you can put in the lesser of $19,000 or the profits you made from your business.
Okay, so like in an IRA, what's the most you could put in?
I don't even know. I think it's about $5,000.
Nothing. It was $55 last year. I think it's $6,000 this year. I think it goes up. So that's a single person. I think a married person was $6,000 a piece this year. Seems to go up every year a little bit for inflation reasons. Like last year, I think it went up $500. But my point is, it's still minuscule compared to what you could do if you have a 401k. Not to mention the matching capability that your business can match you, right?
Absolutely. And
so now it gets ridiculous.
Yeah, it really gets crazy. It gets fun.
Yeah.
Now, a couple things. There's also catch-up contributions. If you're unfortunate enough to be over 50 years old, you can add in another $6,000. So now we go from a $19,000 contribution to it can be $25,000 you can put in the blink of an eye with your business.
So explain catch-up. What do you have to do to qualify to be able to do a catch-up contribution?
You got to be over 50 years old. Congratulations, you're qualified.
Oh, so that's all it is.
That's all it is.
The day you turn 50, you can just throw in an extra $6,000 that year.
You can throw in an extra $6,000 that year.
That year or every year after that?
Every year thereafter.
Oh, wow.
Yeah. So that's pretty cool. So now we're up to $25,000. Now, draw back with these contributions for the pass-through, for the sole proprietorship, for the partnership. You don't get an employment tax deduction. So if this income would generate something that's subject to income or to employment taxes, you don't get to write off the contribution against your employment taxes. So let me give you an example. Let's say I made $20,000 for the year from my business. Okay, and I put all $20,000 inside of the 401k. I don't have to pay any income taxes on that $20,000.
But you still have to pay the employment tax as if you had made it.
Yeah, and that's another 15%.
So the government wants their piece of the...
They want their piece of the pie.
Yeah.
So that's the contributions for the 401k contributions, and the way that we document it. Once again, we go back to all those documents we talked about before. We have the salary deferral agreements, which we have that video on how to fill it out. You just say how much you want to have taken out of each paycheck and or out of a bonus, and that's how you do the paper trail and document making those contributions into the 401k side of the retirement plan.
Well, that's simple enough.
Once again, we've already gone over this. You can't use rental income as the basis for those contributions, and you can't use interest income as the basis of those contributions, but otherwise you're fine.
Again, if you have rental income, then form a management company and get the funds that way through the management company. If you have a loan company, then find a way to work part of whatever you're charging into fees or underwriting fees or whatever. There's ways to... It's all how you set things up.
It's how you set things up.
All right, we're on to segment number 13. We'll be talking about salary deferral contributions for the corporation.